Recently, the Australian dollar has fallen to its lowest level since 2020, sparking debates on topics ranging from Australia's balance of trade, the potential for RBA rate cuts, commodity prices, and all the way to countries on other side of the world affecting this nation as we speak. In today's video, we're going to be looking at why the Australian dollar has fallen so low, what this means for our country, and why a high and low dollar can be both good and bad. Before we start, it's probably worth mentioning a little bit about how our currency works. In simple terms, it's due to both the availability or supply of the currency and the demand for it. For example, going overseas as a tourist to buy a product, you need foreign currency, and to obtain it, you must sell your native currency. The relative value between two currencies are determined by what's called an exchange rate. The same rule applies for foreign companies who want to invest in Australia. They must use our currency to conduct their business here. The supply and demand of currency is dependent on a variety of factors. For example, a nation with a high interest rate is likely to have its currency perform stronger against other currencies, as government bonds and term deposits become more attractive to foreign investors, which increases demand for the currency. If we look at the opposite, if a set of foreign investor regulations were passed in Australia, it could drive the dollar downwards as investors become uncertain or begin fleeing, selling their Australian dollars to transfer their wealth to other countries. Generally, what influences the Australian dollar is how many people want our currency and how much of it there is, with the demand of the currency generally being influenced by economic activity within a country, while the supply of the country is generally controlled by the government through monetary policy. In recent times, the Australian dollar has hit its 5-year low, hitting its lowest level since 2020. Trading around about 0.62 US cents or 4.47 yuan at the making of this video. This is primarily due to two reasons. The first is the fall in commodity prices such as iron ore and coal, which are key minerals that make up Australia's primary industry sector and overall industry. The decline has been driven by a reduction in demand from countries like China, with the nation facing internal instability from things like their property market dragging the economy. The subsequent increase in supply for commodities has also put downwards pressure on commodity prices and our dollar as a result. The second reason is that both our domestic market and society are expecting the RBA to shortly cut rates, as inflation has steadily approached the 2 to 3% target range set out by the central bank. This expansion in market expectations, as well as the release of our latest economic figures, has likely caused some action in Australia's repo markets, and has driven currency-based investors out to more lucrative nations with higher earning potentials. The rapid weakening of the Australian dollar in a short few months also raises the point that we have a very volatile currency compared to that of other G6 or developed countries. This is driven mostly by the Australian economy being comprised of what are called low value added industries, such as mining, agriculture and raw mineral exports, which themselves are vulnerable to vast price fluctuations. If we look at Canada, our most similar nation compared to us in regards to raw economic figures, we can see that their currency is more stable than ours due to having a much more diversified economy and less reliance on primary industries. Canada also has a much more diversified trade with other nations such as the US, Mexico and Europe, which means that they're less prone to economic windfalls from other countries. Australia, on the other hand, while slowly shifting from China, is still heavily reliant on them. So when they perform poorly, we also tend to perform pretty badly. The implementation of 10% tariffs by the Trump administration on China certainly hasn't helped in the decline of the Australian dollar, with the early fall likely part of the market expecting China to perform worse already, as demand is cut back from US buyers and Chinese import prices rise. Now that we understand why the Australian dollar is weak, it's worth talking about how a low Australian dollar can be both good and bad, and it all depends on your perspective. If we zoom out and assume Australia had a stronger dollar relative to the US, then it would mean that we'd enjoy greater buying power to purchase imports, but at the consequence of our exports being much more expensive in a competitive international market. which would hurt our big industries such as mining, agriculture, and tourism. On the other hand, if our dollar was even lower than it already is, our big exporters would be performing better due to the currency being cheaper for foreign buyers. But the downside would be that now everything from China, the US, and Europe just got a whole lot more expensive. As you can see, there are positive and negatives to having either a low or high Australian dollar. While there are many more ways a dollar can affect a nation, we've covered the most obvious and impactful ones. Now, if we take all that previous information into account, a low dollar will likely put more pressure on our cost of living, as foreign goods have become more expensive to buy. But as a positive, our domestic industries are expecting to export more to international markets because our iron ore and coal are, for example, a whole lot more cheaper than other countries. The low dollar also means Australians are more inclined to shop domestically for products, as they become more cheaper in relation to more expensive imports. A low dollar has also driven Australia's tourism and education, further boosting GDP for the economy. This is positive for the incumbent Albanese government, which has faced criticism by Australia's opposition, the Liberals, and a drop in popularity from Australians overall. Regardless, the fluctuation of the dollar in recent times has sparked expectations from the public, with the potential to cut interest rates soon. While the RBA is certainly more hawkish or more inclined to cut the cash rate, the weakening of the dollar also comes with the risk of imported inflation from other nations, as the price of foreign goods such as TVs, furniture and cars rise. If the RBA cuts the cash rate, it will likely put more downwards pressure on the dollar, and could worsen inflation caused by imports. Whether you're an individual, a business, or a government employee, the Australian dollar affects us all. And as a matter of public importance, it's crucial that we cover the Australian dollar. Economics can be a complex thing, but we try to present this information in simple terms to appeal to a wider audience, and so that you can understand at least more than half of the stuff politicians and economists talk about. Let us know how we did in the comments. Thank you for watching this video. If you've enjoyed our content, consider subscribing and ringing the bell so you can keep in loop with all the latest news from Australia and around the world. We're also proud to announce we've released our 5th edition of the Snapshots newsletter, covering all the news from January. You can access it down below in the link provided for free. Once again, I'd like to thank our supporters and the team for making this video possible. Your support is crucial, and if you'd like to continue supporting us, consider buying us a coffee, our merchandise, or purchasing a membership. Your support would be crucial, especially in some of our upcoming projects such as our podcast series and our coverage of the 2025 Australian federal election when it's announced. Once again, I'm Heath Clark, thank you for watching, and I'll see you in the next video.